Section 12 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 4, Part 2, Long-Term Capital Management. That's what history had proved to them. In August 1998, Russia defaulted on part of its national debt, panicking markets. Russia announced it would restructure its debt and postpone some payments. In the aftermath, investors dumped higher-risk securities, including those having nothing to do with Russia, and fled to the safety of U.S. Treasury bills and FDIC-insured deposits. In response, the Federal Reserve cut short-term interest rates 3 times in 7 weeks. With the commercial paper market in turmoil, it was up to the commercial banks to take up the slack by lending to corporations that could not roll over their short-term paper. Banks loaned $30 billion in September and October of 1998, about 2.5 times the usual amount, and helped prevent a serious disruption from becoming much worse. The economy avoided a slump. Not so for long-term capital management, a large U.S. hedge fund. LTCM had devastating losses on its $125 billion portfolio of high-risk debt securities, including the junk bonds and emerging market debt that investors were dumping. To buy these securities, the firm had borrowed $24 for every $1 of investors' equity. Lenders included Merrill Lynch, J.P. Morgan, Morgan Stanley, Lehman Brothers, Goldman Sachs, and Chase Manhattan. The previous 4 years, long-term capital management's leveraging strategy had produced magnificent returns: 19.9%, 42.8%, 40.8%, and 17.1%, while the S&P 500 yielded an average 21%. But leverage works both ways, and in just 1 month after Russia's partial default, the fund lost more than $4 billion, or more than 80% of its nearly $5 billion in capital. Its debt was about $120 billion. The firm faced insolvency. If it were only a matter of less than $5 billion, LTCM's failure might have been manageable. But the firm had further leveraged itself by entering into derivatives contracts with more than $1 trillion in notional amount, mostly interest rate and equity derivatives. With very little capital in reserve, it threatened to default on its obligations to its derivatives counterparties, including many of the largest commercial and investment banks. Because LTCM had negotiated its derivatives transactions in the opaque over-the-counter market, the markets did not know the size of its positions or the fact that it had posted very little collateral against those positions. As the Fed noted then, if all the fund's counterparties had tried to liquidate their positions simultaneously, asset prices across the market might have plummeted, which would have created exaggerated losses. This was a classic setup for a run. Losses were likely, but nobody knew who would get burned. The Fed worried that with financial markets already fragile, these losses would spill over to investors with no relationship to LTCM, and credit and derivatives markets might cease to function for a period of 1 or more days, and maybe longer. To avert such a disaster, the Fed called an emergency meeting of major banks and securities firms with large exposures to LTCM. On September 23rd, after considerable urging, 14 institutions agreed to organize a consortium to inject $3.6 billion into LTCM in return for 90% of its stock. The firms contributed between $100 million and $300 million each, although Bear Stearns declined to participate. An orderly liquidation of LTCM securities and derivatives followed. William McDonough, then president of the New York Fed, insisted, quote, no Federal Reserve official pressured anyone and no promises were made, unquote. The rescue involved no government funds. Nevertheless, the Fed's orchestration raised a question. How far would it go to forestall what it saw as a systemic crisis? The Fed's aggressive response had precedents in the previous 2 decades. In 1970, the Fed had supported the commercial paper market. In 1980, dealers in silver futures. In 1982, the repo market. In 1987, the stock market, after the Dow Jones Industrial Average fell by 26% in 3 days. All provided a template for future interventions. Each time, the Fed cut short-term interest rates and encouraged financial firms in the parallel banking and traditional banking sectors to help ailing markets. And sometimes it organized a consortium of financial institutions to rescue firms. During the same period, federal regulators also rescued several large banks that they viewed as too big to fail, and protected creditors of those banks, including uninsured depositors. The rationale was that major banks were crucial to the financial markets and the economy, and regulators could not allow the collapse of one large bank to trigger a panic among uninsured depositors that might lead to more bank failures. But it was a completely different proposition to argue that a hedge fund could be considered too big to fail because its collapse might destabilize capital markets. Did LTCM's rescue indicate that the Fed was prepared to protect creditors of any type of firm if its collapse might threaten the capital markets? Harvey Miller, the bankruptcy counsel for Lehman Brothers when it failed in 2008, told the FCIC that, quote, they, meaning hedge funds, expected the Fed to save Lehman based on the Fed's involvement with LTCM's rescue. That's what history had proved to them, unquote. For Stanley O'Neill, Merrill's CFO during the LTCM rescue, the experience was indelible. He told the FCIC, quote, the lesson I took away from it, though, was that had the market seizure and panic and lack of liquidity lasted longer, there would have been a lot of firms across the street that were irreparably harmed, and Merrill would have been one of those, unquote. Greenspan argued that the events of 1998 had confirmed the spare tire theory. He said in a 1999 speech that the successful resolution of the 1998 crisis showed that, quote, diversity within the financial sector provides insurance against a financial problem turning into economy-wide distress, unquote. The President's Working Group on Financial Markets came to a less definite conclusion. In a 1999 report, the group noted that LTCM and its counterparties had, quote, underestimated the likelihood that liquidity, credit, and volatility spreads would move in a similar fashion in markets across the world at the same time, unquote. Many financial firms would make essentially the same mistake a decade later. For the working group, this miscalculation raised an important issue. Quote, as new technology has fostered a major expansion in the volume and, in some cases, the leverage of transactions, some existing risk models have underestimated the probability of severe losses. This shows the need for ensuring that decisions about the appropriate level of capital for risky positions become an issue that is explicitly considered, unquote. The need for risk management grew in the following decade. The working group was already concerned that neither the markets nor their regulators were prepared for tail risk, an unanticipated event causing catastrophic damage to financial institutions and the economy. Nevertheless, it cautioned that overreacting to threats, such as LTCM, would diminish the dynamism of the financial sector and the real economy. Quote, policy initiatives that are aimed at simply reducing default likelihoods to extremely low levels might be counterproductive if they unnecessarily disrupt trading activity and the intermediation of risks that support the financing of real economic activity, unquote. Following the working group's findings, the SEC, 5 years later, would issue a rule expanding the number of hedge fund advisors to include most advisors that needed to register with the SEC. The rule would be struck down in 2006 by the United States Court of Appeals for the District of Columbia after the SEC was sued by an investment advisor and hedge fund. Markets were relatively calm after 1998. Glass-Steagall would be deemed unnecessary. OTC derivatives would be deregulated, and the stock market and the economy would continue to prosper for some time. Like all the others, with the exception of the Great Depression, this crisis soon faded into memory. But not before, in February 1999, Time magazine featured Robert Rubin, Larry Summers, and Alan Greenspan on its cover as, quote, the Committee to Save the World, unquote. Federal Reserve Chairman Greenspan became a cult hero, the maestro, who had handled every emergency since the 1987 stock market crash. End of section 12.